Welcome to the Weekly Juice Podcast, where we discuss all things real estate, personal finance, investing, entrepreneurship, and the many ways to achieve financial independence. We interview accomplished investors and entrepreneurs with the goal that their stories inspire you to take control of your financial future. Here to get your creative juices flowing while also documenting their own personal investing journeys are your hosts, Corey Jacobson and Ryan Bevilacqua.
Welcome back to the Wealth Juice Podcast. As always, it's your boys, Ryan and Corey here with another episode for you. Today we had a fun one. We interviewed Tom Dunkel. He is the Chief Investment Officer at Belrose Storage Group. He specializes in self-storage. And we talked, this was a masterclass on how to invest in self-storage and the tactics that Tom and his team kind of undertake as they go take down properties. It's really, if you've heard a couple of our episodes when we talk about multifamily real estate and how to passively invest in large multifamily syndications, it's very similar, but it's just on the self-storage front. And he took us through his strategy is value add, and they buy all over the country. They have about 7 different states, including Georgia, Florida, North Carolina, a couple others. But Corey and I have been so excited and intrigued about self-storage. And this is actually the second episode we've ever done discussing the topic. So,
yeah, self-storage is booming, like truly. And I kind of explained my thoughts about it during the episode, if you listen for it. But Tom's great. And he's local to us, which I thought was, a major plus. He grew up like 20 minutes from where I grew up. He lives like right near us. But one of the other interesting facts about this episode is Tom's had like 2 lives in the investing space and just like his career in general. So he got fired when he was like, with 2006. So 20 something years ago, close to 20 years ago, he got fired from a job, and it forced him into real estate. And that was what I thought was kind of like, oh, he wouldn't have even, went down this road unless he got fired. It's like we're building it on the side, and I mentioned this in the episode, but like he didn't even jump into real estate before he got fired. And like it was kind of this pivotal moment in his life. And he's like, I guess I got to do something different. Like I don't have a choice. And he was a really smart guy, very analytical, and he runs the finances like of the company. So I said this in the episode, like that, not almost like, thank God this happened, right? Because he built this new life for himself, and self-storage is so damn lucrative and profitable. Like we're talking about deals that are 50, 60% returns. Not everyone's like that, but he has got the proof that he's already went through deal cycles of deals that are like that. So I thought it was great.
Yeah. I really like how you brought that up, because it was when we asked him about his light bulb moment when he got into real estate, and he's like, it was more like a lightning bolt. I had to burn the boats. I had no choice. I got fired. He was starting family and all that. And he's just like, he always thought he was going to do something different, and was able to escape the golden handcuffs. He made a decent clip of money and ended up losing a lot in 2006. He mentioned, and as most people do, but as they get into the 2008 story, right? People that have lived through it, and they just climb out. And I think that makes them more weathered and kind of more bulletproof. And it's interesting. Like as we vet people out for deals that we're going to get into and in the future, I really like you uncover people's stories, and the ones that have gone through the most pain, I guess, are the ones that are most, I guess, like equipped to, weather another storm. And he mentioned, ups and downs of self-storage the last couple of years as well. And they were able to weather the storm because they're super conservative the way they underwrite, and they always under promise, over deliver. And I think that's used a lot in business, but just in general, if you're going to give someone a 62% return when they're thinking they might get a 12, 15, like that's pretty amazing. So
all the more reason why you would even want to invest with him. But anyway, so he has deals that are popping up left and right. We swim in similar circles. He's in a self-storage mastermind. He's in Raise Masters. We know some dudes in Raise Masters. So you can kind of tell the connection was there, but great resource if you want to reach out. He's looking for people that are going to help him potentially find deals. I don't want to give everything in the episode away, but just listen up for that as we talk about it, like maybe 3/4 of the way through. Yeah. I mean, I think we should probably bring him in. It was a lot of fun.
Yeah, let's do it.
It's time to flip the script on how you invest in real estate. Backflip is one company out there that is actually changing the game. Backflip is an all-in-one platform that gives you the insights, capital, and community to find and fund your fix and flip real estate deals. The app is completely free. And actually, the part Ryan and I love the most is you can pull comps, estimate profits for multiple exit strategies in seconds, and apply for a personalized loan all in one place. We're talking a 96% loan to cost ratio and no upfront fees. Check it out for yourself. Download the Backflip app today.
Having purchased investment properties as well as primary residences, we know how daunting it can be to find a reliable lender to secure financing for real estate in the market today. With the up and down of the market, high interest rates, and the complexity of the process, honestly, it can feel like a lot. So to help out our community, we decided to bring on probably the most important person or one of the most important members of our personal real estate investing team onto the show to help out our listeners. Our mortgage lender, Travis David of CMG Home Loans, has agreed to educate our community and assist anyone looking for real estate financing. Whether you're a real estate investor looking to fund your next project or simply looking to purchase a primary residence, Travis will be able to help you and point you in the right direction. So he provides each of his clients with a tailored roadmap designed to guide them through purchasing their first investment property and strategically scale their portfolios over time. So if you're looking to either purchase your first residence or maybe second residence, but a primary residence, or invest in real estate, Travis is your guy. Visit our website at www.juice-enterprises.com/need-funding to book a call with Travis to explore all the loan packages that him and his team currently have available. He'll also help assess your current situation and will work with you to map out a plan for the future. So just remember this, we can all win. This is an example we really wanted to help out our community and something we find people are lacking in a daunting process. So if you are looking for real estate financing, we have your back. Make sure to visit our website and Travis will take care of you. Quick public service announcement for all of our listeners. First off, we want to thank you all for tuning into the show, not only this week, but we've seen you coming back episode after episode. And one thing we'd really like your assistance on, if possible, you know that our content's free and it takes a lot to pump this out every week. We're really looking to enhance our overall reviews on the show. That can be on Spotify, but mainly we are looking for Apple Podcasts. If you could please leave us a 5-star review, that will go so long and so far for us. Really, when people are looking to get on shows, they look to see how many 5-star reviews that show has and the number of reviews. So if you haven't left one, please just click on our show. You can scroll down to reviews and then leave the 5-star. Even if you can write a little blurb about us, like what maybe has helped motivate you or anything that is relatable to your life, that would go such a long way for us. And then in turn, it allows us to get high quality guests for future episodes. So if there's been a motivating episode that you can really think back to and that has really helped you in your life, please leave a review because we'll be able to get someone like that on the show in the future to help someone else out. So that would be very much appreciated. And we look forward to continuing more episodes for you. Tom, officially welcome to the Wealth Juice podcast. Corey and I are so excited to have you on the show. As I mentioned to you, pre-recording, we haven't had a gentleman talk about self-storage in a long time. So hopefully you can give us a little masterclass today. We're glad that you're local too. So you're right in our backyard, but welcome to the show and Thanks for joining us.
Yeah, Corey and Ryan, man, it's great being with you guys. Good to hang out with some locals, but looking forward to our chat today. I get excited about self-storage. And I'm solidly in my 50s now, so if I get a little long-winded, I apologize ahead of time. I got a lot going on up here in my noggin, so sometimes it just, starts coming out.
It's all good. Hey, we like that, man. We like that. Drop as many nuggets as you can for the listeners. They'll be very appreciative. So let's start here. Maybe take us back to pre-real estate. I know you kind of gave us who you are, but like where you're from, and then why did the light bulb or when did the light bulb go off? You're like, hey, listen, I need to become a real estate investor. This is my future.
Sure. Well, it was more of like a lightning bolt than a light bulb, because what happened was in 2006, after a successful corporate career, and I'll go more into that in a minute, I actually got fired from my job in corporate finance. I worked at Nutrisystem up in Horsham. You guys know where that is. And I got canned one day. And that was the lightning bolt that just, really pushed me into wanting to finally do something on my own, because I had been wanting to do something for years. And, how do you do that? When's the right time to leave? Because it's kind of cushy. I have a great education and background in corporate finance. I was making really good money. I had the golden handcuffs and wife and 2 little kids at home. So, when do you really find that right time? Well, for me, it was that lightning bolt that day that I got axed, and I just was determined to go and finally go out on my own. But prior to that, I was after business school, I started doing mergers and acquisitions in the aerospace industry, which was amazing. I worked with some incredible people, got a great foundation for financial analysis, building financial models and projections, and also the capital markets, the debt capital markets, equity, different ways of raising that kind of capital and from who and the private equity and, all that stuff. So I had that great foundation. And I was making other people a lot of money, but I wanted to kind of go do my own thing at some point. And when that lightning bolt hit in April of 2006, I remember when it was, it just kind of pushed me out into the real world of entrepreneurship and real estate and building businesses and all that. So it was abrupt, but and it was a little scary. But at the same time, it also felt very natural to be out doing my own thing. So I guess I'm just wired weird and a little different than most people.
I have a question on that, Tom. I don't think you're weird. I think it's a cool story. It's funny. I'm wondering if you feel like it sounds like you didn't have any real estate going on prior to being fired, right? You were doing this corporate thing.
That's right.
I'm wondering if that was like hindsight, the best thing that ever happened to you. And I mean, I'm kind of asking, I don't think you'd be on this podcast if you didn't love what you do at this point. But the reason why I ask is because Ryan and I are in positions where we have good jobs. We've been able to build it on the side. It's been awesome. But I'm wondering, that lightning bolt was like maybe this forcing object that helped you do it. And I'm just curious if you have thoughts on if that was like, if really, I mean, it was do or die, right? Like you had to kind of fix it.
Yeah, absolutely. Yeah, it was no question a blessing in disguise. I wouldn't change it for anything. It was just one of those life experiences, it just kind of pushes you in one direction or another. And so, it did put me in a position of having to make things happen. Right. And this was 2006, guys. A couple years later, the market starts crashing. I'm new. I have no idea what I'm doing. So I got my butt whooped really good those first few years. And to the point of, blowing through tons of cash. By that point, the boats had been burned, right? So there was no going back to corporate. So I had to figure something out. So it was around about that time, 2009, 2010, I started learning about distressed mortgage debt. And so I started buying a couple notes and and that's where I met my now business partner, Joe Downs. We've been business partners over 14 years now. We met at a real estate networking event. So note to the people out there, you never know who you're going to meet when you go to these things. And I was telling him, he turned out he lived around the corner from me. At the time I lived over in Ardmore. He lived in Ardmore. And the Oakmont pub was right there in Havertown, right near where our houses were. So we decided to meet at the pub and talk more about what I was doing. I said, yeah, I'm buying these distressed second mortgages. And he says, you're effing crazy. What do why are you doing that? You're going to lose all your money, blah, blah, blah. I said, well, hey, you're a smart dude. Why don't you go do some due diligence? We'll meet back here at the bar in a couple of weeks and you can tell me what you found out. So a couple of weeks goes by. He goes and does some research, goes to a local seminar, comes back. He's like, I think you might be onto something. So that was the beginning of what's now known as U.S. mortgage resolution, which has done over $56 million of revenue over the past 14 years in the distressed debt world, which we could do a whole other show on that.
Yeah. I'm curious, Tom, how you got from the distressed debt to self-storage. I mean, seems like self-storage is like your bread and butter now. I mean, I'm wondering that path. We can talk about what your portfolio looks like now and then maybe work our way backwards on how you got to that point. Yeah,
totally. So the great thing about the distressed debt business is it can be super profitable. But the bad thing is, especially for me as like an MBA nerd guy that likes to have like a plan and business plan and metrics and KPIs and all that stuff, we just couldn't do it in the distressed debt business because it's such a volatile kind of business. So the success of that business though did allow us to kind of try out some other things, right? So we did some hard money lending. We did some fix and flip stuff. We were partners in a title company for a while. We picked up some short-term rentals up in the Poconos. You guys know where that is. But it was like 2017, 2018, we started hearing more and more about self-storage. And we really liked what we were hearing. And so we started going to the conferences, got educated. 2019, we joined a self-storage mastermind group. And that's where we really kind of learned that there was a huge opportunity there, but also that we were lacking, our team was really lacking some key skills that we needed. Because Joe and I are good like deal guys and financial guys, and we can raise the money and the debt and the equity and that stuff. But we were horrible at finding the off market deals, right? And if you're in real estate at all, you make your money when you buy, and those off market deals are gold, right? So through our mastermind community, we were able to find a guy who was really good at that, but he wasn't good at the finance piece. So it was a great matchup. We complemented each other's skills quite well. And then of course, when you find the deal, you do the due diligence, you get it, you raise the capital and you close on it. Now you got to run the thing, right? And so we didn't know how to run a self-storage facility. So again, through our self-storage mastermind community, we were able to find an expert at running these facilities. And so once we had the team rounded out, that's when gave us the confidence to go out and start buying facilities in 2020. So we bought our first facility then. We've now acquired 16 facilities for about $46 million across 7 states, actually 8 states now. And so we're off to the races pretty good.
I love to hear this. This story is cool because, when you talk to somebody who's been investing in real estate for as long as you have, you mentioned 06, so you're coming up on 20 years of doing this. Mm-hmm. I like to hear that it's like, I tried this, I tried flipping, I tried short-term rentals, because it's paralleling Ryan, my story. Like I'm thinking right. Everyone's like, get really good at one thing. And it's like, it takes a while to figure out what that one thing is. Like, what is right. the one thing that I really want to do? And mm-hmm. Ryan and I thought about self-storage. We've done obviously some, for people that have listened to the podcast, they know some general partnerships on some multifamily, mm-hmm. Short-term rentals, long-term rentals, a fix and flip. We figured out what we did and didn't mm-hmm. like. I'm curious, maybe talk to me about self-storage itself, what sold you on it, yep. and then maybe some of those deals, like what, Ryan, yep. we were talking beforehand, you have some, yep. 50, 60% returns on some of these deals. It sounds awesome.
Yeah. We've had some good ones, but yeah, it was really, there was a lot of highlights as to why we like self-storage. I'll give you like the top 3 or 4. So like I mentioned earlier, our distressed debt business, super volatile, unpredictable. So we wanted something to balance that out, right? So self-storage across the country for the last 40 years, right? Probably older than you guys.
A little bit.
Has the occupancy at self-storage facilities across the country has gently meandered between like 80 and 90%. So if you think about the last 40 years of our economy, we've had ups, we've had downs, we've had, internet bubble bursts, we've had COVID, we've had, huge run-ups, we've had huge crashes, right? We've had all this stuff go on, but yet self-storage remains very, very steady. And so to me, like, I don't know if you guys like going to water parks, but, there's these people that like to go in the water park where, you go down the really fast water slide and you get like you get the water like up your nose and in your eyes, and you get to the bottom and you got a big wedgie. That to me is like other kinds of real estate investing. To me, you'll find me on an inner tube, a little cocktail, shades on, holding hands with my loved one on that lazy river that kind of goes around the outside. That's self-storage because it's just it's steady. It's not recession proof, but it's recession resistant. People use it in good times and bad times for all kinds of various reasons. We're a nation of hoarders, really, is what it boils down to. So that's number 1. It's very steady. Number 2 is adoption, right? So market penetration. Storage is becoming used more and more and more and more, right? So a few years ago, it might have been, maybe 6 or 7% of households were using self-storage, and now it's like 9, 10, 11%. And it might not sound like big movements, but when you consider there's 120 million households in the country, every 1% move is 1.2 million new self-storage customers. And guess what? A lot of municipalities, they don't want self-storage in their municipality, so they don't give away permits very easily. So there's a demand increase and the supply is not able to increase to meet the demand. So we love that as operators, right? Because we've got that supply and demand imbalance. Anyone who might have taken an Econ 101 class, right? That's what you're looking for, because when the supply is less than the demand, you're going to be able to push up your rental prices and keep your units full. So That's what we're looking for when we're in these different markets. And the last one I'll throw out for right now, I'm sure I'll get to another one later, is especially now where we are in this economic cycle. Are we going to recession? Are we not going to recession? Inflation, where are we at?
3 years people have been talking about.
Yeah, exactly. We are coaching our investors to take a capital preservation kind of look at things. Now, you can't sit on the sidelines because inflation is going to eat your lunch, right? So you have to make investments, but you got to be smart about it. So we are coaching our investors to invest in self-storage because it's a capital preservation play, right? It's not going to zero like my internet stocks did in 2002. It's a cash flowing asset and you're getting tax advantages. And over time, everyone knows real estate does increase if you hold it long enough. So for those reasons, self-storage facilities do not default on their loans. You can look at, hospitality, retail, office right now, lots of defaults going on. Self-storage, if you go to Cred IQ, speaking of a local guy, Cred IQ is owned by a Villanova grad who lives in King of Prussia. But he's got a company called Cred IQ, and they track all this CMBS, commercial mortgage-backed securities data. And he tracks all this data. Self-storage, zero defaults.
Interesting.
So,
Wow.
yeah, we look at it as a safe place for investor capital but still giving them an opportunity to make a return and not lose out to inflation.
So first of all, thank you for the breakdown on that.
Sure.
Very enticing and intriguing, I think, at least for us as well, and I'm sure some listeners too. What is your guys' strategy for these different projects? So I'm seeing a bunch of different deals. You have some in Maryland, North Carolina, Florida. It seems like you mentioned 7 states, right? So it's a bunch of different areas in the country. But I'm curious, are you buying these to refurb them and sell them? Like, what's the play here? Because for me, when I think self-storage, I'm like, okay, well, there's just going to be influx and an outflow of tenants all the time. You just keep it and hold it as long as possible, right? And maybe increase cash flows. What's the play and the allure to self-storage, at least for you guys?
Sure. Here's something a lot of people don't know is self-storage is a highly fragmented industry. What does that mean? Well, those big names you've heard of, Public Storage, Extra Space, CubeSmart, right here in Malvern, those big guys only control about 30-ish% of the overall self-storage market. So 70% of the market is like onesie, twosie, mom and pop owners who, their main key performance indicator, KPI is, am I full, right? So all they want to do is keep their units full. So what they do is they keep their rates artificially low, because the last thing they want to do as a mom and pop is have like a marketing department, like I have across the hall for me, that's going to, a marketing department, a web presence, a Google or Facebook advertising strategy. They don't understand that stuff. I didn't understand that stuff until a few years ago. But what they do is they just keep their rates low, so they keep their occupancy high, and then that's how they run their facility. Well, that leaves a ton of meat on the bone for a professional company like ours to come in with our technology, with our platform, our management platform, with our advertising and marketing strategies. We're not afraid of that churn, right? So we'll push rates. If someone leaves, we're kind of glad because we're going to be able to refill that unit with someone at the market rate, which, believe it or not, and we see this all the time, these moms and pops, their rates can often be 20, 30, maybe 40% below where the market really should be. It's crazy. So it's a really easy kind of value add strategy. Is that, again, I warned you guys, I give long answers.
No, this is good.
But that's what we do. We find these mom and pop run facilities and we go in with our value add strategies and we just clean it up and hopefully turn it around in about a 2 to 3 year time period. If there's an expansion or some kind of conversion, or maybe it's a little hairier deal, it might take us, 3-4 years.
This is why
that's basically what we're doing.
Yeah, this is why this is going to sound like a sales pitch for what you do, but that's good. It's natural. I'm just thinking about. As long as consumerism is a thing, which if anybody's listening, consumerism has. If you had to say, has it grown or decreased in the past 10 years? obviously it's decreased because we have little computers attached to ourselves all day long. And I just bought something on Instagram with one click, and I clicked Apple Pay, right? Done. I bought it. And I'm thinking, as long as that trend continues, it would lead to people having more shit in their house. And that's really what it comes down to. I just cleaned out my basement and thought, I have stuff in here that, like, personally, I'm not a hoarder. I like everything clean, but like I have stuff in here that, like, if I got any more stuff, I would need to put it in a storage facility. And I imagine that's really the trend that happens. So I think that self-storage is only going to continue to grow as people have more accessibility to buying things quicker. You don't have to even go to a store anymore. And that's been that way for a long time. So that's my sales pitch there.
Corey, you're spot on, man. I mean, let's see, I guess it was a couple months ago, there was a headline that came out on one day and a headline came out the next day. The headline came out on one day said, consumer spending was up like whatever, 2%, 3%, across the country. And then the next headline that I saw in the following day was credit card defaults are like increasing and are like higher than they've been, in like 20 years. I'm like, how can these two things be happening at the same time? But both, they just, to your point, it's so easy to do these impulse buys on your smartphone, Amazon, whatever you're on, Instagram, clicking ads, buying stuff. And that's what people are doing. And, it's just look at anybody's house or basement. Like you said, it's like people are just buying stuff and they need a place to keep it. And that's also another reason why we like the Southeast, where Ryan, you were noting where some of our facilities are. Well, they're down in Georgia, North Carolina, or down in Florida. Guess what? Down there, there's no basements. There's no basements, and it's too hot to go in the attic. So they gotta find somewhere else to put their stuff, and that's where people are moving. Right? They're moving out of the Northeast where we are, and they're moving to the Southeast and the South, and so we're just riding that demographic wave.
So, Tom, let me ask you this. Are you guys essentially, you mentioned the time horizon here, right? 2 to 3 years. Is that the play every time? You guys look to just get it to top market and then sell it?
Pretty much, yeah. I mean, we're looking to compound. We're an IRR driven organization. So in other words, we're trying to get a quick return for our investors so that we can sell that asset when that return curve starts to flatten out and plateau. That's when we look to sell, because then we can go and find the next deal where we can crank it up again. So we're looking to compound our investors' returns over multiple deals over multiple years.
Got it. So I'm just thinking, it's funny. I'm paralleling this to, we've had a lot of people talk multifamily value add, right? So I'm just thinking about this and kind of seeing how similar they are, if they're almost exactly the same. So a couple questions for you. I want to start here. You mentioned like compound the returns. Do you typically, let's just say, I'm looking at one of your deals here. Let's just call it the Mount Airy, North Carolina deal, 62% ROI.
Yep.
Huge ROI, right? Like I'm thinking like most multifamily deals, you're not getting more. Not a ton of times more than 10%, truly. So my thought is, for someone that's interested in investing this, you guys get this under contract and then you reach out to your investor base. Is it the typical, hey, accredited investors, you put $100,000 down and you keep it for the 2 to 3 years, you get your cash back? Talk to me about if there's waterfalls, the whole payout structure. And then part B of that is, do you just hope they roll to the next deal and give them a siphon of their cash back? I'm just curious how this whole thing works.
Yeah, for sure. I mean, thankfully, Ryan, that's what ends up happening is our investors, when we do exit a deal, they will reinvest with us. So we have many investors who we've just gotten to know over the years. They know, like, and trust us. They understand our process. They understand what we're trying to do. And when we put a deal out, they're in. So we have multiple investors that we've worked with over the years. It's like every deal, it's like $100,000, $100,000. I don't even think they look at the materials, to be honest with you. So I think that's telling us anecdotally that we're doing something right. And so we're really happy about that, because that's really what we're here to do. I mean, self-storage is great. We love it for many reasons, but it's just a vehicle to really help people grow their wealth sustainably and predictably. So that's what we love to do here, is help people grow their wealth. So, but to part A of the question, when it comes to structuring, so we do have a waterfall. So yeah, the investor will put up their 100,000, and we have two classes of shares. And this has evolved as we've been growing our investor list and we've been listening to our investors. We found that there are some investors that, they're just looking for that passive income, and that's their most important thing. They're willing to forego some of the growth in exchange for a higher upfront payment. So we have what we call our Class A preferred equity, and that's typically like a 8.5, 9% current pay along the way, and that just stays steady throughout the project. And it's cumulative. So if there is a hiccup or something, we'll make up those payments in the future. But when we sell, they get their 100,000 back, and they get usually about a 5%, what we call an equity kicker, which is 5% of the net profit that's left over just right off the top. So that usually equates to about a 10, 11, 12% return. But which for some investors, because it's kind of in a priority position, they're like, hey, I'm cool with that. It's giving me my monthly check. I'm trying to do this financial freedom thing and be off on the golf course. So we have that class. We also have Class B, which we call our common shares, and that is more for folks that can tolerate a little more risk and are looking for more of that growth play. So those investors, if they put up 100 grand, their preferred return is probably going to be like 5 or 6%. Again, we pay that monthly. It is cumulative. But that can increase over time as the value add strategies start kicking in and the cash flow starts cranking up. We can escalate that preferred payment, that equity payment to the Group B, Class B, over time. And then at the end, they get their money back. They get their initial capital back, and then we do a profit split. So we split the profit up to a certain hurdle rate, and then the profit split switches more in our favor because we figure, hey, at that point, we've done a pretty solid job. So that gives us the opportunity to make a nice profit split. And I think that really does a nice job aligning our interests with our investors.
Totally. Yeah, it's very similar to multifamily, which I really like. It just it doesn't confuse me, which is good.
Yep.
Now,
by the way, I'm a big fan of multifamily. I've been a passive investor in multifamily since 2013, so over 10 years. So big fan.
There you go. Yeah, makes sense where you're at. So maybe take us through one of these deals. We'll let you pick. I know I talked Mount Airy, but I just kind of start to finish and dumb it down, right? But, I know there's a ton of nuances. There's a ton of there's a lot of financial lingo that they're just going to get wigged out. So maybe just how you guys find the deals. I know you mentioned some of the teammates that you have on the team, like the plan of action, but I'm curious, just, is it, 100 grand every time for someone? Can they put in 50 grand and just give us an example of a payout for an investor?
Sure. Yeah. So our minimum is 50,000. Our average is about 100. But yeah, so that's how that works. Are you wanting me to go through a deal that's gone full cycle?
Yeah, that'd be perfect.
Yeah, sure. So Mount Airy, you're going to tax my memory a little bit because we sold that maybe a year or two ago. But Mount Airy, North Carolina, that was Granite City Storage. We bought it for $3 million, and I want to say the ROI or the NOI, the net operating income, which is kind of your gross rents less your operating expenses, your taxes, insurance, utilities, management, repairs and maintenance, that stuff. I want to say it was around 300,000, give or take. And so we bought it for $3 million, which is about a 10 cap. But back then, that was, we bought it in January of 2021. Back then, those deals were out there in storage, not in multifamily. And so as I described earlier, we went in, this was interesting. It's a smallish market. There were definitely some competitors, but as we analyze the market, and this is one of the things we've gotten really good at over the years, we analyzed the market. We looked at the competitors, and what we found is that all the competitors were full, which is a great sign that there's demand in that market. But it's also a sign, and most people might stop at step one there. But step two is it's also a signal to us that we can push rates, because if we push rates at our facility and one of our customers says, well, you guys are pushing my rate, I'm going to go down the street. Well, guess what? There is no down the street because those units are all full. So now you've got a tough decision to make. Do you eat the whatever $10 a month increase, maybe $20 a month increase, and you got to go and you got to put all your crap in the back of your Subaru and drive it who knows how far to get to the facility that's going to offer you a lower rate, if you could even find one? Or do you just leave it there and absorb that rate increase? So that's what we did. We were able to push the rates there, and not even by like a ton. I think we pushed them like 21% over like an 18-month period. And that put us on trend to take that $300,000 NOI on more of a trajectory of $400,000. And so we were able to do that in a pretty short period of time. And then we ended up selling it for just under $4 million about a year and a half later. So, of course, the magic of leverage, we had a loan on that. We had raised a little over $1 million. So after we paid off the loan, I think we had $1 million and $1.6 million or something to distribute out to our investors. So, they all made their nice fee, their return. We made a nice fee, and a bunch of those investors came with us into the next deal.
So, Tom, would you say your strategy is, it wins in the management aspect of the deal? And the reason why I asked this question is because it doesn't sound like, and correct me if I'm wrong, that you're like turning these units into like, oh, we're climate controlling them now, and we're adding all these features to like drive it up because that's going to drive up your expenses. Basically, what you're doing mostly is managing it better and understanding the market value. Would I be correct in saying that?
100%. Yeah, I would say, probably 80 to 90% of the value we create is because we're better at managing these things than the mom and pop. And that's one of the things we look for when we're out turning over these rocks and making offers on facilities, is we're looking for these opportunities to implement these strategies. The one thing we are doing, Corey, is we do add a revenue stream, which is tenant protection. We can't call it tenant insurance because you got to have a license to sell insurance. So we have a tenant protection program, and it's just, and this is the amazing thing about self-storage and also about multifamily, right? These little increases in revenue, like per unit or per apartment, can really compound into something awesome. So we make, I want to say like $6 per month on our protection plan, but you take $6 a month across 400 units across 12 months, and you throw a cap rate on that. Next thing you know, you've created like $500,000 of value in that facility, like without breaking a sweat. So we love looking at those kinds of opportunities.
Yeah, absolutely. I'm curious about maybe some of the challenges that you come across. Like, it doesn't have to necessarily be a horror story, but like, what's something that you felt like, maybe you mentioned, obviously you went through '08 in real estate investing. Like, I'm wondering, because there's a lot of people that started in real estate investing when we did, and that would be like, I bought my first property in 2018. So it's, aside from COVID, it's been, which I'm not going to mitigate that, but it's been pretty good in real estate, right?
Sure.
It's not hard to win. You've seen some different aspects of it. I'm curious what some of the challenges either that your company has or that you've had personally as you've built your portfolio.
Sure, 100%. I mean, we have an amazing operations team, and we're going to be making an announcement later this summer about an addition to our operating team. In fact, he's coming on as our chief operating officer, and he's coming from, I have to keep it on the down low, but he's coming from one of the big companies, and man, he's already like doing some work with us, and he's making a huge difference like right out of the gates. But we're really focused on operations, Corey, because that's what we can control, right? We couldn't control a 500 basis point increase in interest rates last year, right? And, we can't control the inflation and, what's going on with wages and energy prices right now, and, consumer confidence and defaults, all this stuff, right? We can't control that. So we're just doing the best we can with what we can control, which is running that facility as best as we can. So we're being smart, where we need to. We're offering concessions to get customers in, and then we can, boil the frog slowly, inch up rates over time. But that's really where we're spending a lot of our time now. We're building out a really amazing technology platform where we are able to. Remember, I mentioned analyzing the market and the competitors earlier. Well, we've now automated that. So we can scrape the internet for data, and we can plug it into our software, and it'll tell us like where our rates should be. So it's really pretty slick. And so adding something like that, and we have some other tools that we're adding into our management platform, is really allowing us to make the best of any facility that we run across. Now, like I said, we can't control the macro economy or any of that stuff. So sure, not only did we, have some occupancy and some rate challenges, post COVID when we, last year, and, things were coming down across the entire self-storage industry. So we certainly weren't immune to that, but we managed through it best we can. And with my background, back in my aerospace days, building those models and those projections, working with these amazing people and these private equity guys and these, Harvard MBAs and these Wall Street analysts and stuff, like I learned back then, like it's always better to underpromise and over deliver for your investors, because, you never know what's around the corner. So we're always being very conservative with our projections. And so that's something that I've kind of brought into the culture here at Belrose Storage Group, is just being conservative. So have we lost deals because of that? Absolutely. We've definitely lost deals because we were too conservative, or we just weren't sure, and we wanted to be safer, because obviously, we're raising capital. It's not one thing to lose your own money. It's really bad if you lose somebody else's money. So we're out there making sure that, we're dotting I's and crossing T's and just controlling what we can control.
Cool. That's cool. Question for you. So I know a lot of these are 506C and for accredited investors only. Do you guys ever have opportunities 506B for friends, family, and like local within your network?
We've done some of those in the past, Ryan, but not recently. It is interesting you bring that up there, because we often have investors coming to us like they want to get involved in storage, or they want to get involved in alternative investments, and so, but they might not be accredited. So, we've been working on a couple ways to work with those folks. So, we've been looking at lending opportunities, because you can be a lender, and you don't have to be accredited to be a lender. And we're also looking at if, depending on how involved someone might want to be in the self-storage industry, we actually are putting together a program that's going to help people basically be bird dogs for self-storage facilities for us. So for those who don't know, as a bird dog is someone that goes out and finds deals, and they might not have the resources or the skills to really do the proper analyzing and raise the money and take it down. But if they find something that looks interesting and it fits in our buy box, they can bring it to us at Belrose Storage Group, and we can pay them a fee, or get them compensated somehow or another if they bring that deal to us. So we're trying to find those different ways to work with the non-accredited folks out there.
That's cool. That's a great way if anybody's listening. And we always talk about like, how can you provide value to people that are a few steps ahead of you? I mean, that right there is like a number one thing that you can do if you understand the analysis or how to find deals. And maybe you don't know how to do it now, but like the internet is pretty wide, right? So you could learn. So that's awesome. I want to get into just a couple personal questions. Ryan, did you have anything else on the actual? Okay, cool. So
before we get to that, like I mentioned, we actually just put the finishing touches on a bird dog program. So if someone wants to reach out after the show, I can get you in touch with my man Jack, and get you looped into our wholesaling and bird dogging.
That's what it's all about. That's great. We'll make sure to share your information as we wind down the show with how to get in touch with you. But cool. So Tom, you mentioned, I don't know if it was on the recording or previous or before the recording, that you just entered the 50s realm, right? So
Yep.
this question, I like to ask it to people who are older than us, who have seen more and done more.
Mm-hmm.
I'm very curious about your 18-year-old self. Like, if you could, I like to get to know you, like what makes you tick, and personal information about like what advice would you give yourself, knowing what you know now?
Mm-hmm.
You went through this corporate life, you've had a second life in the entrepreneurial world, or at least in the real estate investing world, in the self-storage. Like, what would you tell 18-year-old Tom? And I always say this, it's like, I'm not saying he would listen, but if he would listen, what do you think you would tell him?
That's right. Yeah, that's a great question. It definitely wouldn't listen. 18-year-old Tom was pretty lazy. Gotta tell you that. He was just kind of coasting through high school, had maybe a little too much fun in college, but
or at least the Tom that was, whenever he would start listening, whether that's 25, 26, I don't know. Maybe it was 35, who knows?
Yeah, hey, maybe I'm not there yet, Corey. I don't know, man. But no, I actually gave a talk on this at Raise Fest 2023 out in Louisville, Kentucky last year. I did like an hour presentation in front of about 500 real estate and capital raising professionals. And what I boiled it down to was really three things. One is find a niche. Find a niche that you can get excited about. When I was 18, I feel like I always wanted to do something a little different. And it's not like I was a nonconformist with like, piercings on. I was, that was not me at all. I was very down the middle, but I always felt like I was going to do something maybe a little bit off the beaten path, a little bit different. And I think that's where, they say the riches are in the niches. And I think that that's really true. And I've been able to actually experience that myself. So I would say, whether it's a niche in real estate or a niche in, some other industry, find a niche and then step two is get really educated, just devour as much as you can about that niche. Go to the conferences, read the books, meet the people. And that leads me to number three, which is the people. You got to surround yourself with the best people that you can. So you've got to spend the money to go to the masterminds, join the networking groups, just be around those people, go to the events, right? Because I've probably spent in my career, I've spent over $300,000 of my own money going to these events, doing the mastermind groups, being around those people. And I can't tell you, you get these incredible return on those investments. So I would say, those are probably the three key things there.
Cool. Yeah, I love that. I think we've learned this recently, and Ryan and I had a conversation. We have conversations every day, but we had one recently that was like, how much money we've spent on programs and courses and some good, some bad, but it's like kind of all leads you to this position where you're really able to make an informed decision about what you want to do with your future. And without spending the money that you can't be afraid to lose, you kind of never get to that point. And it's like you get stuck in the analysis paralysis, which, life's too short for that. That's what we found out. So I love your story. I think I'm really, I'm not just saying this, I'm really intrigued by self-storage. And I mentioned before the show, you might have some future investors in a deal, but I'm thinking like, we can wind down the show here, Ryan. Did you have any other questions that you want to ask Tom before we get out of here? Cool. So Tom, it's been a pleasure. I think if you're interested in self-storage or interested in learning more about Tom, you mentioned the bird dogging, like there's opportunities for people to reach out to you. You mentioned you have some offerings right now for people that are accredited investors. I think that's great. What's the best way for people to get in touch with you if they want to network, learn more, try to provide some value of some sort? What's the best way?
Sure. Yeah, Corey, Ryan, it's been awesome, man. Thank you guys for having me so much. I'm Tom Dunkel. I'm the Chief Investment Officer here at Belrose Storage Group in Wayne, Pennsylvania, right near these guys. But we're easily found at belrosestorategroup.com. And if you guys are wondering where the Belrose name came from, remember I told the story earlier about the Oakmont pub in Havertown. Well, our first company was Oakmont Note Group. And then as we evolved and made some money and moved out further on the main line, now we hang out at 333 Belrose, over there in Radnor. So now we're Belrose Asset Management and Belrose Storage Group. So belrosestoragegroup.com. I would encourage folks to go there. We have a great resource there. If you are a new investor, you're wanting to get involved in multifamily, self-storage, lending, short-term rentals, whatever. A lot of people, what I've found in my experience is they have just trouble taking that first step, right? So we have a resource that's free on our website at belrosestoragegroup.com. It's called the Safe Investing Workbook. And SAFE is an acronym. Of course, investing is not safe. There's risks. But if you use the Safe Investing Workbook, it gives you a due diligence framework so that you can take that step and look at those investments. And just real quick, SAFE is an acronym, SAFE. S stands for sponsor. Too many people skip this part. I don't get it. You got to understand who you're handing your 50 grand to. So you got to know who your sponsor is. So ask them a lot of questions, get to know them. If you're here in the Philly area, glad to meet with you. But yeah, get to know your sponsor. A is for asset. What is it that you're investing in? I would love for someone that's investing in Dogecoin or some crazy stuff like that. Like, what is it that you're investing in? And you're investing in self-storage, I can show you the physical property. F is financials. What are the financial projections? What are the IRRs? What are the tax implications? Those kinds of things. Gives you a list of questions to ask about that. Certainly not exhaustive, but it gives you just a little start. And then E is for exit. How do you get out of this thing? It's not like you can go to schwab.com and click and sell your position in a Belrose Storage Group deal. It just doesn't work that way in storage or multifamily or anything. So you need to go into a deal with an understanding and a comfort level, knowing that your money is going to be tied up for 2, 3, 4 years, whatever they say. So that's just a quick overview of the safe investing method. But would love to catch up with anybody who's local to the Wayne area, Philly area.
Cool. Tom, this has been awesome. Thank you so much for coming on. We appreciate your time, and you got a great thing going on here, as you already know. So thanks again.
Thank you, guys. It's been fun.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.